Bond market performance in the first quarter of 2018 highlights the benefits of regional diversification within your fixed income portfolio. February's higher than expected wage data highlighted concerns on both the level of inflation as well as the Fed's reaction function. This translated into both higher yields and higher volatility. Yields in the U.S. rose significantly, making the U.S. one of the worst performing bond markets. Performance within spread sectors was mixed, as investment-grade corporate credit and agency mortgages posted negative excess returns, while local emerging markets posted positive excess returns. The fund was positioned well to navigate this volatility in markets and outperformed its benchmark during the quarter. A combination of yield curve, country, and currency positioning led much of the outperformance. The fund benefited from having a lower duration exposure than the index in places like the US, UK, and Canada, where yields were rising. We also benefited from overweight positions in Portugal, Spain, and South Africa, where yields fell during the quarter. The fund is well positioned to capitalize on opportunities if volatility persists in markets. On a sector basis, we continue to maintain overweight positions in emerging market debt, inflation-linked bonds, and investment-grade corporate bonds. The overweights are offset by underweight positions in developed market sovereigns and U.S. agency mortgage-backed securities. While the fund has been underweight duration relative to the index, we've been looking for opportunities to cover some of that short position as rates have risen closer to fair value. The fund's currency strategy is centered on a core short U.S. dollar position. However, we also see value in a number of relative value currency pairs, like being long Scandinavian currencies against the euro and being long the Japanese yen versus other Asian currencies. Going forward, we think headwinds are likely to persist for fixed income markets. A renormalization of monetary policy in the US, UK, and Canada is likely to continue over the next few quarters. It's important to note, though, that the pace of that renormalization is likely to be quite slow, and while rates will be rising from current levels, they'll still remain low on a historical basis. Despite the net decline in US equity prices and rise in volatility, financial conditions remain accommodative. This is an environment which we think will reward active managers like ourselves, offering many relative value opportunities, both within countries and sectors. Thank you for taking the time to watch our Q1 2018 update.